give everybody another minute or two to get logged in here. Ryan, welcome. Let me get the slides loaded while we're waiting. Any questions before we get going that you've come across?
Can you explain the format of the exam for next week again?
Sure, absolutely. So the format is it's going to be online. I'm going to limit the time to a little more than half the class period, and I'm going to make the exam accordingly. It'll be multiple choice and matching. We're going to use the lockdown browser and Respondus, so make sure you've got a camera readily available so that you can do the scan of your workspace, and then it'll kind of monitor, make sure that everybody is copacetic, and the lockdown browser.
That we have to memorize the formulas and everything.
No, absolutely not. Now, and here's the thing with the Respondus thing. I don't give you the formula sheet on the computer, but I do allow you to print it off. So just make sure that you have a printed copy. And, when you're doing the scan, just show both sides, whatever you have paper-wise for the formula sheet. I think I just posted that on the module section under midterm. And Respondus is going to say, oh, you're looking down. That's okay. You're going to have a calculator too. I understand all of that. So, but do make sure you have that camera and do that scan initially. And then you'll have an hour and a half to do the exam. We'll start right at 6:30. You'll have that formula sheet. And then if I can ever get to it, maybe I can show it to you. I'll try again. And then let's see, what else? So about 80% of the weight is going to be on the multiple choice questions. About half of those are going to be problem oriented. The other half are going to be conceptual and or definitional. And then the other 20-ish% is going to be matching. So I'll give you a definition and you have to pick the appropriate term. I am going to, this is weird.
So I guess that means that we can't use Excel. We have to use a calculator.
Correct. Yes. I have tried that in the past when we first went into online and remote, and it was not ready for prime time. I don't know what you all's experience has been, but my issue with it was that it worked for some students and it didn't work at all for others. And I feel like that makes an inequality between, if I don't know whether it's your system or at least, let me put it this way. A year and a half ago, the rollout with Excel built in was not ready for prime time. So I haven't updated. Do you guys have any experience? Has that worked have you used that maybe like this spring? Has that worked well?
I've never had to take an online exam with a lockdown browser before.
Okay.
Personally.
All right. So maybe it's still not ready. I'll keep checking on it. Let's see, David, you said so we will not be live in class. Actually, we will be live after the midterm, and I'll talk more about that in just a minute. So you'll have 15 to 20 definitions, and I'll give you more like 25 to 30 terms. So make sure that you know that nuanced difference. So in fact, what we're going to talk about a little bit tonight, I'm going to jump ahead a bit. We're going to talk chapter 5. And you're going to find in chapter 5, we have all kinds of terms that are really close together. So there are primary shares, there are secondary shares, there are primary markets, secondary markets, third markets, fourth markets. You're going to need to be able to separate those out and define which is which. And so make sure that you go over those terms well. That's probably an easier one to ace than it is with the multiple choice. and I do not know why. Let me see if my Wi-Fi is not.
The exam will be in Connect.
Oh, what? I'm sorry, I didn't. I don't understand the question, Alvaro.
Will the exam be through Connect?
Oh, will the exam be through? No, it will be through Canvas.
Okay, okay. But we
Yeah.
can go back to the questions after we submit it, or how does that work? Like, we can go back. Let's say, I don't know, question 1, I can go back to question 1, or...
You'll have access to all the questions until you submit it.
Okay, perfect.
Yeah, I won't do it. I don't think that works well, one question at a time. My strong preference in taking an exam is to be able to go back to questions. So,
I was worried about that.
yeah, no, you'll have access to all the questions until you submit. Let's see. Well, the Wi-Fi is supposedly connected. I'm a little low on storage, so maybe that's the snafu. But go to modules, and under the heading midterm exam, you should see the formula sheet. And that should give you an idea of what to expect there. Oh, and then back to, did that fully answer your question, Katie?
Yep, thank you.
Okay. And then back to David's question. What I'd like to do after the midterm, I'll give you about 15 minutes to decompress and grab a drink of water and a snack. And then, so we'll start at 6:30. We'll run till 8. So then if you would come back to the Zoom, come back to your computer and log into the Zoom session at 8:15. I would like to spend that last hour talking about the security analysis project. So I will give you the firm we're going to do. I'll kind of give you an overview of the entire project and what it's going to entail. You'll be spending the rest of the semester working on that, and you'll be working on it in teams of 3. Let's see. Anyone else having trouble getting into Canvas? Yeah, me. Maybe it's Canvas and not so much my my system. But yeah, I'm still not getting in. Luckily, it was working when we needed to start Zoom. All right. Let's see. Does that help, David? Does that answer your question? Okay. Very good. And by the way, you all might start thinking, if you haven't already, really start thinking about who it is you want to be on your team. My recommendation is look for skill sets. If you're really more finance oriented, look for somebody who's an accountant, or vice versa. Look for somebody who has got a different set of skills than you, so that together as a team, you can collaborate better. Sometimes it's not as good to work with necessarily a friend who may have a lot of overlap with your skill sets. So keep that in mind. I have to go back and look at the role to see how we're going to break this up. I would like the teams to be separated by undergrad and grad. So if you're a grad student, get a team of 3, yourself and 2 other people who are all grad students. There may be one team on each side where we need to have 4, but I'll look at the role between now and next Tuesday, and we'll see whether that's the case or not. I know when we started that was the case. I haven't gone back to see. I know we lost one person. I don't know if we've lost any more. All right. I see Caitlin and Justin. Welcome. And Alvaro, John. Let's see. Anyone else? I don't know that anyone else is coming in. Let me just double check email here, make sure. Maybe there is. Yeah, okay. Andy's having problems getting in. Nicholas is as well. So this sounds like a problem with Canvas. Let me just go briefly here to my Zoom page, and maybe I can get them in. without having to go into Canvas. Looks like Canvas is down. Maybe it's more widespread than that. I'm having issues getting into the Zoom page too. I don't know if we host that. Go back here. Aha. Okay. I did get into Canvas. And let me just copy this URL for the couple of folks that can't get in. All right, that's going off. And get one more here to Andy and Vincent. We've got several folks that are having difficulty. And Anthony. All right. Okay, so any other questions before we get rolling here? We've got 3 or so more people that will be joining us shortly. Anything else that you can think of? All right. So we've got a fair amount to cover tonight, and between tonight and Thursday. What I'd like to do tonight is to get done with Chapter 6 before break and get started on Chapter 5. I'm shifting the order that we're talking about it in class for one primary reason, and that is 19 and 20 is material that you have probably, especially 20, that you have most definitely seen elsewhere. That's economic indicators and that sort of thing, macroeconomic stuff. You all have seen that, and it's relatively self-explanatory. Likewise with Chapter 19, it's a little less so like that, but it's predominantly about ratios and pro forma financial statements. And again, largely self-explanatory, doesn't require a lot more than the reading. I will touch on a few things in both chapters, but I'd like to jump into that Chapter 5 material to make sure that I've covered that thoroughly, because that chapter can get really confusing. So I'm going to shift, even though you haven't read Chapter 5 yet, or at least it's not due until tomorrow night. Don't wonder why we're shifting around. That's why we're shifting around. And let me go here, get Chapter 6 open, and we'll get going. And I'll get out of the way. Okay, so where we stopped, we had gotten into talking about relative valuation. And we had looked at, actually we ended by looking at the Asweth-Damodaran video. And by the way, that set of videos is just excellent. I would highly recommend that when you have time. You don't probably want to do it right before the midterm, but certainly immediately after, browse some of those YouTube videos that he has. It's a great set of videos. I've got a list on the, I believe it's in the resources under the first day in modules listing those. I'll have to go back and double check where that is. But there are some in particular that are even more valuable, and that is as it pertains to your security analysis project. And that's where you'll get the most value, is by going through that stuff with Asweth. We jumped a little bit past this. One of the most widely used ratios for relative valuation is the PE ratio, right? And that's simply price per share over earnings per share. The inverse of it is earnings yield. You could look at that too. But most people look at it as PE ratio. And again, I really strongly recommend that you think about this thing. If we have a PE ratio of, say, 20, I always think about it this way. We've got price in the numerator. We've got EPS in the denominator. This is always in dollars. So what we're really talking about here is that what that ratio means is that we are paying $20 today for a dollar's worth of earnings tomorrow. Now, obviously, we'll own that stock and we'll get another dollar's worth, hopefully, or more, the next year and the following year and the year after that and the year after that. But the interesting thing here is that, when we start seeing PE ratios going higher and higher and higher, let's say we've got a PE ratio of 40. It's not unusual. And remember, we're paying $40 today for a dollar's worth of earnings. Now, the stock price might be 80, and that's $2 EPS, right? But still, when we do the math, it's $40 per $1 unit of earnings. Think about that. Let's say the firm didn't grow at all. Let's say earnings stayed constant. What happens to the present value of a dollar 40 years from now at any reasonable discount rate? It shrinks down to something so small we can barely see it. It's pennies, if we're lucky. If it's a higher discount rate, it's fractions of pennies. $1. So, you go, well, if I hold it 40 years, no, you won't get your money back. So what's implied in this PE ratio, especially when they're high PEs, is that if you don't have growth, you're never going to get your money back. So be very, very careful when you talk about PEs. And remember what we looked at last week. We looked at how PE changes higher or lower depending upon three elements. One was growth. The second was riskiness of the firm. And the third was investment needs of the firm. Those three factors can mislead us very easily. We might see a low PE stock and we go, I'm going to be the next Warren Buffett. I'm going after value stocks. And all of a sudden realize, oh, wait a minute, I just bought a really risky company. That's why the PE was so low. It wasn't a value stock. It was just a regular old stock. It was just risky as all get out. So always comb through the financials, always comb through the annual reports, read the management discussion. Very important stuff. Warren Buffett does it. If it's good enough for him, it's good enough for me too. And by the way, high PE stocks are often referred to as growth stocks. Well, they darn well better be growth stocks. If they aren't, I got a problem. And that's the other thing, is that we can see stocks whose price gets driven up because they're meme stocks. That's the latest thing, right? People start talking about them on Wall Street Bets, on the subreddit, and all of a sudden the price bids up. But really, that the growth rate of that company hasn't changed. It's just become very popular. So be careful not to confuse. High PE stocks they're not all the same. They're not all growth stocks. Some are just very popular with investing public. Likewise, value stocks. Not all low PE stocks are actually value. Like I just said earlier, some of those might be just extraordinarily risky companies. And they look like value stocks because they have a low PE. Never judge a company on one parameter. That's definitely going to lead you into trouble. All right. Other ratios that we could look at. Another very likely candidate here is the price to cash flow ratio. Now, as a finance person, I'm always happier to see a price to cash flow ratio than I am a price to earnings ratio. But we live in the world that we live in, and it's a heck of a lot easier to pull net income off of the income statement, or actually just download EPS from virtually any source, than it is to actually calculate a cash flow. As a result, we tend to use EPS, the price over EPS, rather than price over cash flow. Now, if the earnings are very clean and management is not trying to smooth earnings or do any sort of earnings management, then PE and price to cash flow should be very similar. When they deviate, it's probably because management is doing something to the earnings stream to make it look different for whatever reason. Nothing illegal about it, nothing untoward even about it. It could just be how they decide to account for, certain costs. Inventory. Do I account for it as LIFO or FIFO? That's going to have an impact on your earnings stream. And if we look at actual cash flows, they're going to look different. So always keep that in mind. If you want the gold standard, it's price to cash flow. Then you don't even have to worry about, is management trying to manipulate earnings for a particular purpose or not. All right. A little harder to calculate, but a very good ratio. Price to sales, we talked about that last week. Forget about price to sales. It's garbage. The only time you ever even want to think about price to sales is if you have nothing else lower on the balance, if you have nothing else below revenues on the income statement, that's a positive number. Then you got no choice. But otherwise, the problem is that each firm, remember, this is all relative valuation. So what we're doing is we're taking a firm or a group of firms, we're calculating this ratio, in this case, price to sales or price to revenue, for that group of firms, coming up with an average, and then we're applying it to our subject firm. Well, the trouble is that the cost structure of our comparable firms could be very different than our subject firm. Or even among the comparable firms, they might be very different. And we can't control for that easily. So always go as far down on the income statement as you possibly can. All right. Price to sales, I would never, ever use that unless I absolutely had no choice. Price to book is another widely used metric. It has its value as well. One of the weaknesses of price to book is, again, how the book value was arrived at. It's a historical value, right? We document the value of each asset at the time that we acquire that asset. So if we acquired assets 30 years ago, they're on the balance sheet as of 30 years ago price. If we acquired them last year, they're on the balance sheet at that price. Same asset. Maybe it's an asset with a very long life, but the prices are very different. The other thing that balance sheets don't capture is something like human resources, right? If I have a service company that's highly reliant upon the employee base, that's not on the balance sheet. So I might see a very high price to book. And if I'm trying to compare a service organization to a organization that has more assets or requires more assets, physical assets, that is, I'm going to come up with very weird numbers. So again, a useful ratio, but be very careful how you use it. It says down here under the price to book, a ratio bigger than 1 indicates that the firm is creating value for its stockholders. Even that is not always true, right? Because if those assets were acquired many years ago, it could be that now those assets are just worth more. and the market's valuing the assets. So you still could have a price to book or market to book, as it's often referred to, greater than 1, but not actually have created value. All right. Here are a couple of examples. I'll work through the first one. I won't do the other two. And I also want to mention something very important here as well, and that is the textbook uses one method of how we might be able to calculate a value of a subject company using relative valuation techniques. And what they say basically, and this is not incorrect, but I'll tell you why there's a problem with it, is they say, well, the best comparable for my subject company is the company itself last year, the year before that, and the year before that. So why don't we just calculate the price to earnings ratio, or whatever ratio it is we're looking at, for our subject company last year, the year before, and the prior 3 years before that, and average them and use that as the appropriate multiple? And the answer is, okay, no problem. Yeah, it's probably a good proxy. As long as the company hasn't changed its risk substantially or changed its business model over that 5-year span, that's okay. That's good. What's missing, though? What is it that technique is not capturing?
It's not telling us whether or not the firm is doing well compared to competitors or the market.
Yeah, definitely, and in particular the latter, right? We see markets go up and down. We see PEs of the average firm in the market go up and down. So what it's not capturing is that, say, the last 5 years, the market was just kind of relatively flat. And all of a sudden, this last year, it just took off. If we're going to use those prior 5 years where the market was so-so, just kicking along, bouncing along, up and down, but not really going anywhere, then we probably are underestimating the value of our firm. Or vice versa. Maybe the market's gone down substantially. So we're not capturing that contemporary component. And if you believe that markets can be inefficient at periods of time, or that there can be extraordinary growth during certain periods of time, either one is okay. Different assumptions behind both. Then you really don't want to use a historical PE. You want to use today's PE, and the best way to get that is to look at comparables. So rather than go 5 years back, what I'm going to do is I'm going to look at 5 comparables and see what their PE is right now, today. Because remember, price is forward-looking. So that numerator is always going to be forward-looking. Then I've got a better shot at capturing, if the market is really hot and heating up in a particular industry, I've got a better chance of embedding that in my estimate of price for the subject company. All right. So I'm not saying that what is shown to you in the textbook is wrong. It is not wrong by any stretch. It's just missing a very important element. Most analysts are not going to do this. Most analysts are going to use comparables. The other thing that we always have to think about, and I'll talk more about this in a minute. I've got a table of some current PEs, and the other thing to worry about, and this is true of any ratio, but in particular, PE gets misused a lot, and that is, do we have a PE that is what's known as TTM, trailing 12 months? Do we have last year's PE? So in other words, we're taking today's price dividing by last year's EPS, or do we have a forward-looking PE? That is taking today's price dividing by the forecast EPS for next year. Now, there's a consistent ratio. These others have an inconsistent time period. Because remember, price is always forward-looking. Price doesn't care what happened yesterday. Price only cares what's happening right now and what's going to happen, or at least what we expect is going to happen tomorrow and the day after and the day after that. So if I look at trailing 12 months, in the numerator, I've got looking forward. In the denominator, I've got looking back. Likewise, last year's EPS, numerator looking forward, denominator looking back. A forward PE, the price is looking forward, the EPS is looking forward. So that's a very nice consistent estimate. But as with everything, there's a problem with that, right? Because we don't have crystal balls. So my EPS estimate is going to be different than yours. It's going to be different than a third analyst. And so those are always more difficult to come up with and to really, truly know. And we'll see what I'll show you in a graphic that I've got here about why that's important. All right, so enough of that. The actual rote calculation here is pretty simple. We've got the average of the PE for the last 5 years. And that turns out to be 15.9. That's our multiple. All right, so we put that down here. Then we take our current EPS, and the way we're going to forecast that into the future and calculate our forward, our expected EPS, is we're going to grow it at some estimated growth rate. In this case, our growth rate is 0.9%. So 1 plus 0.009 times $3.22 gives us next year's earnings, times the multiple gives us a price of $51.66. And if we looked at Intel's price as of 2019, it was $47.30. So given that these things are all estimated with some error, if I believed in this method, I would say, that's a hold, right? Because it's not that far off the market price. More than likely, we're estimating with some error. So my guess is that within whatever interval we would call a 95% confidence interval, the current market price would probably fall in there. So that would be a hold. Certainly wouldn't be a buy, and most definitely would not be a sell. Okay? So the actual calculation is relatively simple. I think that's why your authors actually chose to demonstrate this method rather than going with the more complicated means of doing this. Price to cash flow, same animal. The only difference is that the price to cash flow multiple is different, and then they actually have a different estimated growth rate for cash flows per share. And they come up with a very different price estimate. And likewise, price to sales. And again, do not use price to sales. It's bad. Don't use it. All right. Another very popular metric or ratio, besides PE ratio, is this thing called enterprise value to EBITDA. And enterprise value has some important elements to it that, in particular, when we're when we're talking about a startup firm, enterprise value can be a very important adjustment that we make. And EBITDA is certainly a fine denominator too. By the way, if you use a ratio like this, EV over EBITDA, it's also consistent. So here's how we would actually go about doing that. So if we had equity worth 800 million, we had debt worth 300 million, and we had cash on the balance sheet of 100 million. And I should note that this cash is not, in actuality, it's not really the account value on the balance sheet. It's the amount of cash in excess of what's needed to operate the firm over the course of a year, right? So think about a retail firm, right? Your big season is the last quarter of the year, right? Starting in October and going through the end of December. That's where you're going to make or break the firm. You're going to need a lot of cash flow to get you through the other 3 quarters of the year. So you've got a fairly large pile of cash on the balance sheet just to get you through those first 3 quarters, so you can make all of the money that you generally make in the year. Most of it gets made in that last quarter, right? That money is not the money we're talking about here. What we're talking, let's say that number is 50 million. I need 50 million to get me through first 3 quarters where revenues are below costs. So I'm burning through money. And I figure I burn through about 50 million in the first 3 quarters. But of course, in the last quarter, I make up way more than that. So I always come out with a positive profit. And that's perfectly okay. But I need that 50 million. That 50 million is not what we want to subtract off here. What we want to subtract off is any amount above that 50 million. So let's say this particular firm had 150 million on the balance sheet, but we needed that 50 of that to actually get us through the year. So this number is actually the excess cash. That's the amount that we don't need to actually run the business. And the reason I mentioned earlier that this is very important, especially when we're dealing with a startup company, is that the burn rate at startup companies is huge, and that can go on for years. So we don't want to value cash. I mean, cash is worth cash. It's easy. Let's get it out of the way, and let's get on to the stuff that's more difficult to value. So that's really what this enterprise value is, the value of the firm minus the extra cash that we need to keep the firm going through which time we actually start making a profit. Especially, like I said, if we're a startup company, we might need to have $500 million on the balance sheet in order to get to the 2 or 3 years down the road where we're actually going to start making money. If we don't have it, we may as well forget about starting the company to begin with. All right, so that's the nice thing about this enterprise value, is it basically says, look, cash is just cash. We value it at what it is. So let's subtract it out of the picture. So to figure out what the enterprise value is in this particular firm, we have 800 million in equity, we have 300 in debt, and we have this excess cash of 100. So we subtract that off, and it gives us $1 billion in enterprise value. Now we need EBITDA. So that is earnings before interest, taxes, depreciation, amortization. And the EBITDA is right here on the income statement. So then we take that 1 billion, divide it by the 200 million EBITDA, and we get a EV to EBITDA of 5. In other words, for every dollar of EBITDA, the market is valuing this company at $5. All right? Questions on any of this so far? I've been rolling through this pretty quick and I haven't stopped, so I don't see any questions in the chat, but yeah, go ahead, Caitlin.
So when you said that, could you repeat what you said about oh gosh, with the like $5?
Oh yeah, sure, absolutely. Yeah, so when we have that ratio, so it's EV over EBITDA equals 5. And here again, I always like to put that latent 1 in there just so I recognize that, what this is really saying is that for every dollar's worth of EBITDA, the market is valuing that dollar of EBITDA at $5.
Okay.
So it's just like the PE, except there we're valuing a dollar's worth of earnings to equity. Here we're valuing a dollar's worth of earnings to equity, debt, and actually ostensibly to the government too. Here there's an assumption embedded in here that basically the tax rate across all of the companies that we're looking at is going to be relatively close. If that's not true, then we need to make an adjustment there as well.
Okay. Thank you.
Sure. Good question. Other questions?
Yeah, so you're saying this ratio is telling us what the market is valuing every dollar EBITDA.
Mm-hmm.
Where's the market value come in though? With if the equity is worth 800 million in this example,
Mm-hmm.
where does the market value come into play?
Well, it's the market value of the sum of equity plus debt, right? So since we have 200 million in EBITDA, that at a multiple of 5, basically we're taking it depends on which way we want to go, right? So in this particular example, what we're doing is we're saying, gee, let's figure out what our enterprise value is. Let's divide that by our EBITDA, and let's figure out what that ratio is. Now, we could compare that ratio to other companies in the same industry and get some sense, are we above, below, pretty much the same? How is the market valuing those companies? And then we might want to start looking at ways, let's say that the market is valuing other companies in our same industry at 6 times EV to EBITDA. We might say, well, whoa, that's a big difference. I mean, that's millions of dollars in difference in value. If it were 6 times, it'd be 1.2 billion in equity and debt. So how can I unlock that extra 200 million? What do I need to do? Maybe it has to do with my leverage. Maybe it has to do with my risk. Or obviously one's related to the other. Maybe it has to do with my cost structure. Maybe it's something to do with my business risk. How do I unlock that? So that's one direction to get to this. Let's look at using this kind of the other direction. Let's use an average EV to EBITDA to value a subject company. So in this particular example here, we have similar firms with we calculate their EV to EBITDA, and we come up with an industry average of about 6. And this is a different firm than the one on the previous slide, right? That was Courtney's Kayaks. This is QWERTY Corporation. All right, so that industry average EV to EBITDA, we're going to take all of the other companies that are closely related to QWERTY. We're going to calculate their EV to EBITDA. We're going to add those up and divide by that number of companies. We're going to come up with 6 times EBITDA as a reasonable estimate of value for that industry. Then we go and we find, well, what's the current or forward-looking? Actually, ideally, we're looking at forward-looking. So we want to figure out what is our next year's EBITDA for QWERTY. Let's say that that number is 50 million. Now, we simply take this multiple from the comparables or comparables times the EBITDA of QWERTY, and if you do the math here, so we've got this EV over EBITDA times EBITDA. So that cancels, we're left with enterprise value, right? So that tells us that the enterprise value for QWERTY, if it's similar to these other companies in the industry and going to be valued similarly, should be worth 300 million. Then we can go out and we say, well, we're really interested in equity value. We can go out and we can find the market value, and it's I want to emphasize market value here. We need to use the market value of debt, not the book value. It can be very different numbers. We go out and let's find the market value of debt. Let's also find the excess amount of cash there. And let me get out of the way for just a second here, so you can see all of this. Here's our market value of debt, 75 million. Here is the amount of excess cash on QWERTY's balance sheet. Remember, we need to leave a certain amount of cash in there for the firm to operate on an annual basis. But they've got 25 million more than they need for that, for whatever reason. So that generates, if we take the 300 million that we got up here, all right, subtract from that the value of the debt, and then add back that excess cash, because cash is worth cash, then we end up with a value of equity, aggregate value of equity of 250. All right. And then that means that we take that 250 million and we divide by number of shares outstanding. And that gives us price per share. And we can compare that to the market. Does that help, Reed?
Yeah, so when you're saying market value of equity, it's kind of like fair value. Because when you said market value of equity, I was thinking market cap, but it's not.
Yeah, well, in this particular case, what we're actually saying is the fundamental value of equity or the intrinsic value of the equity. Then we're going to compare that to the current market price and see whether those two match up. If the fundamental value is above the market price, then it might be a buy. If it's below, it might be a sell. If it's pretty close to it, it might be a hold. If you find something that is misvalued by the market, that's really, at the end of the day, that's kind of what we're really after here. We're looking for things that are misvalued by the current market price. To get market cap, you simply take market price times shares out, right? And this would be the closest thing. If you looked at market cap and compared it to this number, this 250 million, then you'd still come up with the same decision, right? If the market cap were below 250, if it were, say, 200 million, you'd go, oh, this looks like a buy. It's undervalued. And vice versa. If it were, say, 300 million, then you go, well, I don't know. Fundamental value is 250. Using this particular technique, Market's got it valued at 300. I don't know that I want to run out and buy that stock because it might go down. Now, I could actually become very much a risk taker and short that stock with the expectation that it will go down in the future. So, yeah, market cap is not necessarily a term that directly applies to this particular example. Here we're looking at, we're trying to figure out a fundamental or intrinsic value. I use those terms interchangeably. Those are very much synonyms. Those are think about it this way. A fundamental value or an intrinsic value is the value of the firm if I knew everything about it. And I could perfectly value it. Now, the market price may or may not be equal to what I think is the fundamental or intrinsic value. And then, depending on which side of the market price it is, will tell me whether I buy or sell or hold. Does that help? Sure. Go ahead, Vince.
Yeah, so we were kind of talking about like low PE ratios earlier in value investing.
Yeah.
My one question is, I understand that numbers don't lie, but at the end of the day, there's a lot of times where there are value stocks that never pop.
Yeah.
My question to you is like, what is like the percentages of like when you're doing this stuff? Yeah, it might be a value company, it might be a value stock, it might be a good buy, but it never pops. Is that like a common thing, or like what do you say to that?
Yeah, it's a very common thing. It's a very common thing. It's the old, it might be a gem, might be junk. And many times it's junk. it's total junk. That's why people like Warren Buffett, for instance, quote unquote, value investors, looking at companies that are low PE, but he doesn't buy all of them. In fact, he's very highly selective on which companies he does buy. He's looking for companies that have generated a reasonably stable track record, that have, a cost structure that is easily predictable, doesn't need a lot of capital investment at the moment. What else is he looking for? A very stable employee base. You can predict what your cost of employees is going to be. That sort of company. Maybe a company that's doesn't have to be particularly off the charts growth, but has a very stable and even somewhat recession-proof growth. Look at something like See's Candy, right? A company that he bought, I don't know how many years ago, and is part of, I think it's still part of Berkshire Hathaway, if I'm not mistaken. Nothing particularly, crazy about that company. It's stable. And with a few embellishments made by Berkshire Hathaway, it comes out a winner. So, that's it. It requires a lot of homework and a lot of legwork to actually ferret out which of those companies, which of that pile that generally looks like junk is actually a speck of gold. I would say the percentages are very highly weighted towards junk being in that pile. Not quite as bad as probably panning for gold. I was watching a YouTube video, this guy who goes up to beaches of Lake Superior and pans for gold. He goes through pounds of sand and ends up with a couple of tiny specks of gold. And there is gold up there. It's just that it's far and few between. It requires a lot of work. It's not quite that bad, but it certainly is not as easy as people who would say that you got to get into day trading tomorrow would have you believe. You can't necessarily pick them out that easily. You got to do a lot of research. Does that help? I wish I had a better answer for you because we'd both be rich. I'm not Warren Buffett, but certainly, with enough practice. I mean, the story is that Warren Buffett would read annual reports for leisure reading. You know, I don't know what he's like as a person, but boy, a guy who reads annual reports for leisure, I don't know. It's sure been worthwhile. Other questions or comments? By the way, let's see. William, you're still here? Good. I do have a recording, so if you're dropping out a lot, don't worry. Just let me know afterwards. All right. So here we've got, this is what I was talking about earlier with PE in particular. So when you look at PE, the numerator, even the numerator can be a couple of things. Most often you're going to find people using the current price. But you could say, let's use the average price over the course of the year. Because if I'm using trailing 12 months earnings, why shouldn't I go back and look at the average price over the course of that same period? That might be a slightly more consistent numerator denominator, right? So one can certainly make an argument for that. But like I said, this last one here as a denominator, that's our gold standard. Forecasted EPS, that forward PE. And here, we already talked about that last week, but I will come back and talk briefly about it. Here is why. This is a plot of PE ratios over time. And notice over here on the left axis, we've got, starting back in the 1800s, PE has been running about between 10 and 15. We get into the 1900s. PE took a nosedive here before 1920. Don't even really see the Great Depression in here, which is interesting. And then they've been kind of bouncing around, right? Between like 5 up to 25 until we get into pretty much the 2000s. So right here, that first double peak that we see, that's really, that first part of that is really the dot-com bubble. We saw PE start to really rocket up there. That's close to 45. Now, mind you, this is the S&P 500, the average. So all 500 companies had an average PE of 45. Think about the companies that had higher PEs. I mean, to have that as the average, there were some that had astronomical PEs. And again, here's a really big pop right here, right after the financial crisis. Can anybody explain that to me? You all probably don't remember that period of time as well as I do, but there was a recovery, but it wasn't, crazy. Look at that PE. That's off the chart, literally. And that happened right after the financial crisis. What's going on there?
Could it be possibly because the government may have been pumping money into the Fed, pumping money into the economy, wanting us to spend, and even though companies weren't earning a lot, the stock market runs a momentum, and people are buying more and more stock, and prices were going up.
Yep, that could be part of it. Absolutely. Good point. Good point. There's another piece to this too, though. It's related. So in other words, what Vince is saying is that basically the Fed was making money easy. It was basically printing money. That's what the Fed does. Prints or destroys money, depending upon what it thinks is needed in the economy. In this case, we were really potentially headed for a very deep recession. And so the Fed says, well, let's make it easier to get money out there, easier to invest in things, which can in part drive prices up in the market. We've seen that recently too. At least that some have argued that that's part of what we've seen as the market climb up to 36,000. What else could be going on there? There's one other very important element here.
Were interest rates really low, and so people may have been flocking to blue chip stocks, even
Yeah.
though they didn't have very high earnings.
Yeah. Yep. No, that's actually. So let me correct that. Let's talk about 3 items. That's a very good one too, Reed. So if you're looking for a particular gain and they dropped interest rates, all of a sudden bonds aren't looking as attractive to me. I'm going to shift some more of my money into equities in order to achieve a particular gain, even though I am taking on greater risk. The third thing is that the denominator in these ratios is a trailing 12 months. The economy sucked. Trailing 12 months earnings sucked. The market's looking ahead. The price of the market is based upon not what happened the last 12 months, but what the market expects is going to happen in the next 12 months. And that was really good. So if we had deflated this, or rather divided it, not by trailing 12 months, but by expected future 12 months earnings, we'd see that PE drop way back down. And just to prove that point to you, you don't have to take my word for it. Let's look at some of these. This was, I've got 2 charts here. Where did the date go on this? Did I erase it? Oh, here we go. All right, so this one is recent. I just pulled this off a few days ago. So this is July 14th, 2022. And here we have PE for the Dow Jones Industrial Average. We have and let me go over to the notes here. This cross is trailing 12 months. The carat symbol is forward 12 months from Barinal Associates, updated weekly on Friday. Okay, so the numbers here, the first 2 columns, the first column is as of last, what was that, 5 days ago? So July 14th. Dow Jones Industrial Average, the PE using trailing 12 months was 17.5. A year ago, it was at 26.6. Again, using trailing 12 months. And if we are using the estimate of the future earnings estimated by this Barinal Associates group, then the PE drops even below 17.5 down to about 16.5. So pretty modest. And we see similar things in the other areas here. Now down here, actually, I take that back. This one does have some significant difference. If we look at the Russell 2000, so that's the 2,000 largest firms based upon market cap. And by the time you get down to that lowest 1,000 firms, they get pretty small. If we use trailing 12 months, we get 46. But if we use expected earnings in the next 12 months, it's less than half that value. It's 20.41. Huge difference, right? If you looked at the trailing 12 months PE, you might go, ooh, that seems like it's kind of overvalued. Maybe the market's going to drop in the future. No, the market's not going to drop. You're just deflating by the wrong denominator. Earnings are expected to go up. Now, granted, this particular one was actually I believe, estimated back at 7.8. And that could have changed by now. Let's go back 1 year. Yeah, 1 year. If we're back in July of 2021, here we have a little bigger difference. Here again, we've got Dow Jones Industrial Average on the top row. And so the trailing 12 months, 29. If we use the estimated future earnings, only 20. 2/3. So again, these can matter. It can make a big difference between somebody going, oh no, the market's overvalued, it's going to go down. No, you're just using the wrong deflator. Similar thing over here. Let's see. I don't know why they didn't have a value for the Russell using TTM. For some reason, that's missing. For the Russell, or for the NASDAQ 100, it was 38 trailing and 26 forward-looking. It's not always the case that the forward-looking is lower. It could be that it's higher, especially if earnings were really high last year and earnings were expected to be a bit lower in the subsequent year. That could cause these figures to flip. All right. So, like I said, you don't have to take my word for it. Here's the data. Look at the data. Time-wise, how are we doing? 7:40. All right, good. Just a couple of last-minute things here in terms of how to use these multiples. Let's say we calculate a value based on PE, based on price to cash flow, based on price to sales, based on price to book, and we average all four of those suckers together, divide by, add them up, divide by 4, come up with a number, boom, that's the value of our company. Well, what did I say about price to sales? Total garbage. Why did you even have that in there? Price to book? Not great. Maybe I leave it in there just because it's not completely useless, but let's not equally weight that with price to earnings or price to cash flow. In fact, let's put most of our weight on price to cash flow, a little bit on price to earnings, and then the smallest amount on price to book. Throw away price to sales. That's a much more sensible means of doing this. So don't just blindly go in and average across a bunch of ratios, valuations that you come up with. It's totally inappropriate. Not the reason that I'm paying you 6 figures. And then this slide just mentions what I already said. A much more sensible way is to weight these things based upon how accurate you think each one is. Each one might contribute a slightly different tilt on what you're getting at. And so it doesn't mean that they're valueless, but you might be more confident in one measure over the other. And again, another way is to simply pick a multiple that you think is actually the best and use that. And you're going to hear me repeat this again. You've already heard it once or twice. Even if you do that, or the other method of weighting, always put some sort of bounds on it, right? Never give someone a point estimate because you're almost always going to be wrong with a point estimate. Always put a bound on it. And the more accurate you can be with that, and to the point where you might even be able to say, I've looked back at the data, and historically speaking, I can say with 95% confidence that the actual value is going to fall between these two values. That's really what I'd be going for. And there you'd need something like a Monte Carlo simulation. Parameterize all the variables that you're estimating with uncertainty, and off you go. Now, I know it's much easier for me to say that than it is for you to do that, especially since you probably haven't done it. But we're going to get a little bit of practice on this. The security analysis project, I hope you will have a lot of fun with. That's the whole intent, is to really get you out into the muck and mucking about, because all of this stuff, once you actually get into the real world and use real companies, you're going to find that things are not quite as clear cut as the textbook makes them seem. And it means that it's a much more challenging, much more interesting thing to do. All right. And I'm going to leave off. There's a great example. I like this example. It goes through and gives you Yahoo Finance page with some data. They go through and calculate these various, the value for CVS using these various techniques. And when you do that, what we this still puts me in the way. When you do that, what you find is that, well, look, here we have our old friend, price to sales says that it's worth $118. Yeah, strike that. But even free cash flow says that it's worth $82. And I've got the residual income model that says, only worth $25. Still a pretty big spread between those amounts, even if I strike the price to sales model. All right, so take a look at this. Make sure that you can come up with these same numbers that they came up. You've got the data here, and so use that kind of as a check. All right. Other questions on Chapter 6 on valuation? It isn't speak now or forever hold your peace, but certainly now is a good time. Let's see, time-wise, we're at 7:45 almost. Why don't, actually, this is a good time. I was hoping to be able to get started on 5, but I was a little bit too long-winded. So why don't we take about a 15-minute break here and get a drink, a snack, and come back at 8 o'clock, and we'll pick up on Chapter 5, and should be able to get well into that chapter before the end of class. All right, so Chapter 5. Let me run down out of the way here. This is kind of a fun chapter. I love the valuation chapter because I love all things value. In fact, I'd love to teach a valuation class for the entire semester. I think it'd be a lot of fun. There's a lot deeper dives we can do than just this one chapter, as you probably can tell by what we've already been talking about. Chapter 5 gets into another really fun area that most of us who are interested in investing at least have some desire to learn about, or maybe even already know a little bit about, but this is really largely about the stock market. Now, there's the beginning of the chapter actually is going to require some clarification. I'm not sure, again, I really like this book. Brad Jordan is an excellent writer, and he makes it, I hope you're finding it very approachable as you read it. And I would say to a large degree that's because of Brad Jordan's writing ability and a good copy editor too. But there are a couple of weird quirks, and one of them's at the beginning of Chapter 5. And so let me try to clarify some of that for you. Before we do that, of course, the beginning quotes here. One of the funny things about the stock market is that every time one man buys, another sells, and both think they are astute. It's very true. I mean, interesting. If you don't know who you are, the stock market is an expensive place to find out. And that, too, is also quite true. The old adage about how do you make a small fortune in the stock market? Answer, start with a large fortune. You can very quickly lose a lot of money if you're not careful. Now, the beginning of the chapter, they talk about two things related to private. One of them is private placements. The other is what's called private equity firms. Two very different animals. They both have the word private in them, but that's about the extent of their similarities. Let's start with the private placements first. Private placements are simply a means of placing a security. So a firm wants to raise some capital, right? They're going to issue debt or they're going to issue equity. One choice, that's the one that we're most familiar with, is that they go through a whole bunch of regulatory forms and revealing a variety of data about the security, about the firm, and its cash flows and all the important things that you want to know. And then they issue these to the public. So it could be a public bond offering or it could be a public equity offering. An alternative that many firms use in addition to the public placements that they do, they can do private placements of securities. The advantage of private placements are multiple. One of the key things is that they don't have to go through, the firm doesn't have to go through as much in terms of regulatory hurdles. The reason for that is that the parties that they're selling to are considered sophisticated investors. So these are investors that we don't need the government to step in and say, make sure you show them this and that and this and that and the other thing. These are insurance companies with billion-dollar portfolios. These are pension funds with multi-billion-dollar portfolios and individuals of high net worth with either tens or hundreds of millions or even billions of dollars in their portfolios. So, I mean, even if they are caught off guard and buy into a bad investment, it's not going to be the end of the world. It's just going to be, I got to sell my yacht and downsize to a small 150-footer, something like that. So therefore, there's less regulation. So it's less costly to the firm. Another advantage to private placement, though, is that if you're doing this placement to a small group of individuals or a small group of institutions, you might be much more willing to reveal information that you would rather not be out in the public domain. And so that's another potential advantage. And even if, let's say it's a bond issue, and a couple of years down the road, we run into a situation where our cash flow is constrained, and we'd rather not make a payment, but we're concerned if we don't make a payment, they're going to take us into bankruptcy court. Well, let's gather together those 50 institutions and lay our books out on the table and go, look, folks, here's the deal. Next year is going to be fine. Don't worry about it. Here's what we're dealing with. Here's why you should forgive us for that one payment we're going to miss, and let us go on our way. By the way, we're paying you a really premium rate on this, so hey, would you be kind? And it's much easier to do that than get together thousands or tens of thousands of individuals, institutions, basically make it public knowledge. I don't want this to be public knowledge. I want to be able to share this in a very private sense, but be fully transparent. So that's another potential advantage. Let's see. That's the flexibility part, really, that I'm talking about here. Interesting piece of data here. More than 50% of long-term corporate debt is issued through private placement. So you and I, as investors, we go out there and we try to buy a piece of debt. We can't buy it. Now, that's not to say that you can't get exposure to that group of assets. You can. Through a pension fund, if you want. That's one way to do it. Many of us have access to TIAA, the Teachers Income and Annuity Association. I think that's right. Teachers Income and Annuity Association. And they're an institution that takes on a lot of these private placements. And any of the other big pension funds or large institutions where you can get access to kind of a portfolio of these private placements. So you can actually get exposure to them. You just can't buy them directly ourselves. But they're around, and as this last figure points out, they're a big chunk of the market, a valuable chunk of the market. So that's a private placement. These are securities just like in the public domain, debt or equity, could even be preferred stock. But instead of making them accessible to the world, to any investor, they're only accessible to a select group of sophisticated investors. That does reduce the liquidity of these things too. And that's a potential downside. But if you're a pension fund, you're not probably going to be selling these anyway. All right. Now, that's as opposed to this other name of an institution that also has private in its name, but is an entirely different animal. A private equity firm. I'm sure you've all heard this name. Private equity firms are in the news on a weekly basis, easily. A private equity firm is composed of a firm that has a group of general partners. Okay, so that's this box in the upper left. Those general partners own the private equity firm. And that firm generates some profit through a process that we'll see in just a minute. We won't go into any great detail. This isn't a class on PE, on private equity. Actually, I do have a class I've taught in the past on hedge funds, private equity, and investment banking. And there we go into a great deal of detail on how these firms are structured, what types of investments they get into, and that too can be a really fun class to learn about these things because they're very much in the forefront of investing. All three of those animals. So this particular firm is owned, the firm itself is owned by the general partners. Then they bring into the fold here a group of what are called limited partners. They're over here. And those limited partners participate in some of the investments that the private equity firm creates. And they in particular, they participate in a specific fund that is part of the private equity firm. Now, that private equity firm may have another fund right here, and it may have another fund over here, and a different group of limited investors. So we've got limited partners for this group. We've got a different group of limited partners for this fund. And they could have 3 or 4 more of these funds, all under the umbrella of the private equity firm. Okay? But these limited partners only participate in that particular fund. Now, a typical private equity firm, one of the things that you hear most often that they actually do 3 dominant types of activities. But the one that you usually hear about is called leverage buyouts, LBOs. And a leverage buyout is where the private equity firm finds a publicly traded firm, usually. Sometimes it could be a private firm, but usually it's a publicly traded firm. And they will look for particular characteristics. For instance, they want a large amount of cash flow. They want to make sure that there is no huge investment needed in the future. They'd also love to see a balance sheet that has assets that are really not directly related to the business and easily liquidated. Maybe some tax benefits that they can take advantage of, things like that. Maybe a good management team, or if they don't have one, hey, we'll bring one to the table. So they're looking for a very particular set of firms. And they buy these firms. In fact, if they're public, they use debt predominantly to take them private. So they use some of the equity from these limited partners. Okay. They put in money. Oops, pardon me. They put money into this. And then they raise a whole bunch of debt. and it could be junk bonds. And they put that pile of money together. They go out and buy this firm. Basically, they're buying all of the publicly traded equity. And they may acquire the debt, or they may even pay off the debt that exists in the firm itself. So they're creating a highly levered investment in this firm that formerly was publicly traded, has now become privately held by this fund within the private equity firm. Okay, still with me? So now there's that company right here. Now I do that same thing with another company. I do it with another company. I do that maybe with 6 or 7 more companies, and then I stop. I hold those companies 3, 5 years, maybe 6 at the outside if I really have to. I try to suck basically as much cash out of them as I can while still keeping the company alive. It's much like I'm putting it kind of, forcing the company to become more efficient. And basically, I loaded up with a whole bunch of debt. And they got all these payments on this debt. In fact, it may even be debt that the private equity firm itself has issued. They may be getting some of the return out of it. But nevertheless, it forces the management team to be very efficient with their operation of the firm. And after 3, 5, 6 years, what I do is I get the firm kind of polished up, looking better, and I might actually even do an IPO and take it public again. Get a big cash payday, pay it out to my limited partners. My limited partners are then done. They go away. The fund closes. Once I sell all the firms, we're done. We start over. New fund, new group of firms, potentially the same limited partners if they want to stick around, but it could be a new group or some combination thereof. So sorry for making this slide a really mess of just red scratch, but that, in a nutshell, is a private equity firm. Why in Chapter 5 they talked about the two together, I don't understand. Someday when I see Tom Miller at a conference, I'll ask him. But anyway, so that's private equity in a nutshell. Now we're going to go into some more detail, though, on private equity. It's a very important element in the marketplace. The LBO part of it, in finance, we call that the market for external control of a firm, right? We've got an internal control process. We have a board of directors that oversees the management team, that oversees the employees, and so on, and all of this to maximize shareholder value. But suppose something breaks down in that process. Have you ever seen a board of directors that fell asleep on the job? I have. They're all around us. And so when that happens, management runs amok potentially, or they fall asleep on the job. I don't know. So this external market then comes into play. That's why private equity firms are around. LBOs have gotten a bad name. Private equity has gotten a bad rap in the public media, and in some cases for good reason. A lot of these companies, it's tough to get data on them, but there are literally thousands of private equity firms. A lot of them aren't making money. Now the big ones are Bain Capital, you've heard of, right? Mitt Romney was part of that at one time. So you've always heard of that. You hear about that during political type of things, and so yeah, even Bain got called out for some things. Yeah, they did some things where companies failed. It happens. The company probably was going to fail anyway. Did Bain get a big payday out of that? Well, maybe they did. And I'm not saying that that's necessarily bad either. But they also saved a whole bunch of companies that were probably going to fail. One of the things about finance and about economics in general, there's this thing called the counterfactual. We can never know what would have happened had we not stepped in and done X, Y, or Z. That's the counterfactual. So when we don't have a counterfactual and somebody's got a narrative they want to pitch, they're going to look for the skeletons in our closet. So, like I said, I'm not here as to say that all private equity is good. No, there's no doubt there's bad actors in that market. There are a lot of criminals in finance because finance is so complicated. It's easy to hide. It's easy to scam people. Take a lot of the crypto market, but that's a discussion for another day. So, keep an open mind with regard to private equity. It has its place, and its place is, at least in terms of private equity that does LBOs, is as a market for external control of companies that are falling on bad times, where the internal control mechanisms are not functioning as they should. Then there are two other things that private equity firms have gotten into that are quite valuable too. One of them is venture capital. So you could have a private equity firm that specializes in venture capital. So they're backing startup companies. They're funding those companies. So if you've got a startup company and you're looking for money to expand, you might well be dealing with a private equity firm. You could be dealing with an individual VC or some other form of ownership, but oftentimes it's a private equity firm these days because it's just so advantageous to form the organization in that structure from a tax perspective. There are a lot of benefits from tax perspective to have a private equity firm. There's this thing called carried interest. You also have probably heard that. Well, bad, good, or indifferent, it exists. And in fact, I personally, I think we should get rid of that carried interest exemption, but it's still there. So that makes private equity a very lucrative form of ownership because of that taxation process. So again, I get a group of limited partners. They contribute a whole bunch of money, and I take that pile of money and I go out and I look for startup companies. And those startup companies may need $1 million. And I go, you know what? Sounds like a great idea, but before we give you $1 million, let me see what you do with $250,000. In fact, let me set some very specific targets that I want you to meet. And I want you to meet those within the next 6 to 9 months. And if you meet those targets, then by all means, we'll get you the other $500,000. Oh, and then there'll be more targets, and then I'll give you that final $250,000. So basically, a lot of how these companies operate, they're trying to mitigate their risk, their exposure to a particular company. So they're not just going to give a startup that has no track record a big pile of money and say, yeah, run out and do what you do. Yeah, sorry, not going to happen. What they're going to do is they're going to do this in stages, in tranches. So, you hear about ground floor financing, mezzanine level financing. These are the way they divide up how they give funding to the company. If the company doesn't meet the target on the first tranche, you're done, out, sell them. It's a loss. There are many of those companies that end up that way. I'm looking for that one gem in a pile of junk. And it might be 10%, it might be even less. And that's where my big payday comes, and that's why I'm doing this. And ultimately, I'm going to end up with an internal rate of return that's double digits, very high double digits maybe. That's what I'm looking for. But that's another form of private equity firm. Now, you could have a single private equity firm that has some venture capital funds and another one and some LBO funds as well under one roof. The third activity that they engage in is funding to middle market companies. So these are the companies that may be publicly traded, but may not have quite the access to the capital markets that they would like. And so in come the private equity firms, middle market type private equity firms, and they jump in and say, hey, if you show us a good business plan with a profit coming out in the next couple of years, we're happy to fund this. Here's the terms of the agreement. Here's what we'd be willing to give you. We either want a cut of that, or we want a direct payment out of it, or some combination thereof. So these are already operating firms. They may be privately held. They may even be publicly held. They've got a known performance history, and typically they are small and possibly family-owned or operated, but they could be public too, and just not be able to issue, say, commercial paper, something like that. That requires a much bigger, more established firm. So, by the way, some of these are links here. Here's a list of a few of the PE firms in Cleveland. Companies I don't know whether you've necessarily heard of: Evolution Capital, Elvis Ridge Capital, 9th Street Capital, Blue Point, and so on. So if you're interested in that and you don't want to leave Cleveland, you don't have to. There are opportunities right here in town. So that is, get back here. So that's private equity. I already really talked about this. This is the LBO piece of it, taking a company private. So let's move on. But before I do that, let me stop for any questions about either PE firms or private placements. Anything that comes to mind? All right. Well, let's jump into the stock market. It's about 8:30. Yeah, we should be in pretty decent shape. This is just a list of a few of the terms that you're going to encounter in this section of the chapter. By the way, these are all links. So I've gone either to Wikipedia or Investopedia and given you a link to a definition of each of these terms. There we go. So if you're not sure what a fourth market is, click the link and there it is. All right. So, and sometimes some of these are kind of pairs of firms. We either do an IPO this way or that way. So let's start off with negotiated versus competitive, because that's really chronologically the starting point for a firm that's trying to raise capital. So we're really going to start off by talking about how do firms create these securities? How do they raise money? How do they issue equity? How do they issue debt? I mean, at the end of the day, we see these shares out there, we see these bonds, but where did they come from? So this first part of this section of the chapter is all about where do they come from and what do we call them? And it's important that we understand this terminology and are familiar with it so that we can talk intelligently about this and understand each other. So the first decision, if you're put yourself in the seats of a CFO of the company and you're needing to raise some capital. So the first thing you want to figure out is, who do I talk to? Well, I don't have a lot of inside help, so I'm probably going to go to my friendly neighborhood investment banker. And I'm going to start talking to them. But they're going to want to know, hey, do you want to do a negotiated or a competitive offering? Negotiated or competitive? What are you talking about? Well, do you want to give me kind of the basics of what your needs are? And I'll put the whole offering together for you. You don't have to do much else other than you look over my shoulder, You pay me a little bit of fee money, and I'll take care of the whole thing. We know each other already. You know, you've had some dealings with our investment bank, so it should be all good. The alternative is for the company itself, the company that wants to issue these securities, to come up with a design. Well, I've got to make a decision. Am I going to issue equity, or am I going to issue debt? And then what are the characteristics of that particular security? And how much do I need to sell? Well, if I can kind of come up with the basic framework, then instead of just going to that one investment banker that I already know, what I could do is I could kind of put it out for bid. That's what a competitive offering is. I'm creating the basic framework of what I need. I've determined it's going to be equity, it's going to be common stock, and I need to raise $20 million. It's going to be a seasoned equity offering because I already have equity traded in the public markets, but I need to raise an additional $20 million for this particular project that I think is a positive NPV project. Okay. Put that all together, send it out to a half dozen investment bankers. They get back to me with whether they want it or not. And if they do want it, how much are they going to charge me to do all the due diligence, the legal work, the accounting work, the filing, the regulatory requirements, that sort of thing. And then I pick the one that seems like the best setup. It might not be the cheapest, but maybe it's not the most expensive either. And I go with that one. That's a competitive offering. Now remember the difference. Negotiated, I basically pick an investment banker and they do all of the work for me. Competitive, I at least frame out what sort of securities I want, how much they are, the type of that subtype of that security, and then I shop it around. Most offerings, though, are negotiated. Another interesting fact, most negotiated offerings end up being more expensive than those offerings that we see going competitive. And that presents a little bit of a problem, right? Because at first blush, you would go, wait a minute. These companies are all going with the more expensive option? Are they mismanaging my money? What's going on here? This doesn't make any sense. And the answer comes back to that word I just mentioned a little while ago, the counterfactual. We don't know what the cost had the firms that went with the negotiated offer. We don't know that that wasn't the best price. Had they gone with a competitive, maybe it would have been, the negotiated was still the best deal. And vice versa. Those that took the competitive or went that route, maybe that was the cheapest opportunity for them too. So there's always this temptation to look at those two costs and say, oh, negotiated are more expensive, but all the companies go with that. Are they getting suckered? No, not necessarily. The other rationale for this is that if I'm a relatively small or even a middle market company, I may not have the internal expertise, even at the upper level of my management team, to deal with these complicated financial dealings. I'm building bearings. What do I know about bonds and equities? I know how to keep my company operating, but what I need is more money. I need an investment bank, and I need one that knows me and is willing to do whatever it is to keep me as a good customer. So that also plays into this. But know that most offerings are negotiated. Also recognize that we need to keep in mind that, some are still competitive. All right, so again, a couple of pairs of terms. We have primary markets and we have secondary markets. We can have primary shares and we can have secondary shares. And those secondary shares can trade in both primary and secondary markets, just to complicate things. The primary shares only trade in primary markets. Let me try to help disentangle some of this muck for you. A primary market is the first trade that share makes. And the key to figuring out, is it a primary trade or a secondary trade, or rather, is it a trade in the primary market or not, is to follow the dollars. If the dollars go back to the issuing firm, it's a trade in the primary market, but not necessarily a primary share. But it is definitely a trade in the primary market. Dollars go back to the firm. If you look at the next trade, and dollars go to another investor, but not back to the firm, that trade took place in the secondary market, and it was a secondary share or security. In other words, the first trade means it's definitely in the primary market and the cash is going back to the firm. Once that happens, the firm goes off and it does its thing, builds its bearings. All right, so I mentioned that secondary shares can also trade in this primary market. And that might also be a little bit confusing. And the rationale there is that, let me give you an example. Let's say that the company already has shares trading in the public market. It's already done its IPO, in other words. And let's also say that the company needs to do some additional investing. It's got a really nice positive NPV project it wants to take on, and so they want to raise some money. And let's say that they want to raise $50 million in additional capital. Okay, so we're going to do a seasoned equity offering. That's this guy right here, an SEO. Some people will use the term follow-on offering, and sometimes that term gets used only for a secondary offering that immediately follows the IPO within about 6 months to a year. Other times people use it in a lot looser sense. But recognize that you might hear somebody refer to it as a follow-on offering. So I've got this secondary offering for $50 million. Then I've got a large shareholder. They own 10% of the company. They were a founder. And they have decided that they want to reduce their holdings down to 5%. I don't know, they're getting close to retirement, want to get out, go do something fun, buy that yacht, whatever it is. They want to sell a big chunk of the company. Well, I could do that in the market. They could go out and sell it using an algorithm, an algo, right? Algo trading. That's the dominant form of trading in the market these days, computerized trading. But still, there's a problem with driving the price down because, we don't know. The market doesn't know that this big block holder is just getting out to retire and go have fun, play on the beach or whatever. And it's really hard for that investor, that block holder, to actually signal their true intentions. Signaling is really tough. Here's a solution, though. They go to the investment bank and verify. The investment bank says, they don't know anything. It's not like the company is going under. They just want some liquidity. They just want some cash. So why don't we take that 10 million in shares that they currently own and just tack it on to the seasoned equity offerings of 50 million that we're doing already? And tell the market, this is what's happening. Be totally transparent. That would be, so we've got 50 million in primary shares trading in the primary market. We've got another 10 million in secondary shares trading in the primary market. Those $60 million worth of shares go out into the marketplace. And then the very next trade, the cash goes between investors. And so those are now secondary shares trading in the secondary market, all $60 million worth of those shares. Okay? So I hope that makes it a little clearer. If you haven't read the chapter yet, your head is still probably going, oh my God. Now, we still have two more types of markets to deal with before we're done with this page. And that is, we have a third market. So let me just add one more thing about secondary markets. Secondary markets are the NYSE. They are the NASDAQ. Those are secondary markets. One investor trading with another, and on an exchange. And that exchange is follows a certain set of guidelines. They actually are what are known as SROs, self-regulatory organizations. So the NYSE has kind of got this agreement with the SEC. Hey, we're going to be careful so that you don't have to come in with a heavy hand and regulate us. So we are going to watch out, and we're going to keep everything as clean as we can. So secondary markets are a very important function, and we'll talk a lot more about NYSE and NASDAQ and how they're organized, because that's also important. But lately as in within the last 25 years, for me that's lately, for you that's like forever, we've got two additional types of markets. One was called a third market, which is off the exchange, but still has a broker or a dealer intermediating in the deal. So we never actually trade directly investor to investor. We actually trade investor to broker, broker trades broker to buyer, or other investor. So that's a third market. Key thing is off the exchange, but still with a broker or a dealer. And then finally, the fourth market, and that is, again, off the exchange still, directly with one investor to another. No intermediation. Now, you might ask, well, why did these things crop up? It's all about minimizing the cost to transact, right? You may have heard the term dark pools. Those are definitely fourth market places. You're trading directly with another investor, and nobody knows who the other people are, and nobody reports anything. That's why they're called dark pools. They're like black holes. Not necessarily a good thing, because, again, as an efficient markets guy, I always think it's good to be able to identify who's trading what and at what price. When we get into dark pools, we get into a whole different realm. We don't have really time to delve into it. Again, you can Google dark pools. There's a bunch of writing on dark pools if you're interested in that sort of thing. Anyway, so that's third markets and fourth markets. And again, the whole point of those two types of institutions is to continue to drop the cost to transact. Now, another thing that comes up, and I always like to bring this up, it's not really something that the chapter digs into a lot, but that is the idea of price discovery. And I'm not going to be able to dig into it a lot either, because, again, there are books written about price discovery. Price discovery is, how do we determine what is a fair market price? And how do we make sure that that market price is as close to the fundamental or intrinsic value as possible, and that it stays there? If fundamental and intrinsic value goes up, does the market price follow it? We hope so. And that also has a lot to do with, how does information get incorporated into price? Let me give you just a very basic example of that. Let's say that we all know one thing that nobody else on the planet knows about a particular company, and we know that that's going to double that company's cash flows over the course of the next decade or two. What do we all do?
Go and buy the stock.
Buy the heck out of that stock. Yeah. I'm pouring let's say that we're absolutely certain about this. I'm pouring every bit of money I've got into it. That's 100% return. The moment the market determines that. And you all are going to do the same thing. That's a big group. And then maybe we post on, the Wall Street Bets subreddit and say, hey, we got some good information. Maybe they don't quite believe it because they don't know that they don't have confirmation other than our word that it's true. But still, a bunch of people probably jump on the bandwagon. What's happening to price all along? Going up and up and up and up. That's how information gets embedded in price. Trading. People take actions. And the reverse would be true. If we knew that their cash flows were going to cut by 50%, we would probably run out and short that stock. That would drive price down really quickly. So that's all tied up in this phrase called price discovery. How does information get embedded in price? And how quickly does information get embedded in price? The reason I bring this up to you is that this third market, this fourth market, these are markets that are using price that's been discovered or created in the secondary market, on the NYSE or on the NASDAQ. They're not creating price. They're just using the price that's been created in these other markets to make trades at a really cheap price. So we got a couple of things to worry about here. One is we've got some trading going on that isn't contributing to price discovery. And two, we've got some trading going on that may be at suboptimal prices. So if I trade on that third market, I'm going to save a bunch of money, but I might not get the best price. In fact, that's one of the things that the NYSE is big about advertising, is that, yeah, it's going to cost you a little bit more to make a trade, but I'm going to get you a better price. Let me take it right back to a much more personal stage. Let's say you're selling a house and you decide, you know what, these real estate brokers, they're just stealing money from me. They're charging 6-7% commissions. I'm going to sell the house myself. I'm going to save myself 6-7%. Come up with a price, and I'm going to sell that house. Maybe it'll cost me 1 or 2% because I still have to advertise, still have to do open houses. Maybe I have to kick some to the buyer's broker, so it might cost me 3-4% now. But I'm still saving money, right? Not necessarily. If you didn't know how to price the house, you might have lost a ton of money. If you didn't go out and figure out what your value of your house really was and you priced it too low, you're really losing money. Or say you priced it really high, which is more likely the case, and then you held out and people looked at you and went, are you nuts? I'm not buying your house for that price. And they lowball offer you. And you hang out in the market for 2-3 times the regular time on the market when you use a broker. Are you really saving a lot of money that way? And then you finally get real and people look at the house and go, well, it's been on the market for 365 days. What's wrong with this place? Yeah, so you get the point. That is one of the problems of trying to save a little bit on commissions or transaction costs, being penny wise and dollar foolish on not getting the best execution price. Because you're really looking for the price that you get for the securities. Not so worried about how much it costs me to get that price. If it costs me a little more, but I get a lot more in terms of price, I'll go to the NYSE every day. In fact, if you're trading on Robinhood, if you're trading on E-Trade, TD Ameritrade, you are not, and you're trading a NYSE exchange listed stock, unless you specify, you're not trading on the NYSE. There's this thing called cash for order flow. And basically, or rather, excuse me, payment for order flow is the proper name. Basically, these brokers are getting paid by third markets to route their orders, your orders, to these third markets, which might execute at a worse price. Now, you can on most systems. I don't know about whether Robinhood does this or not. Robinhood is kind of an anomaly, but most of the other systems, you can actually specify, I want it to trade on the primary listing exchange, i.e. NYSE or NASDAQ. And then they will. But if you don't specify, you might not get quite as good an execution on the price. So bear that in mind. All of this comes back to this idea of price discovery and the importance of it, and the importance of markets and exchanges and how they're operated. All right. IPO and SEO details. Both of these are new issuances of securities. An IPO simply is the first time I'm offering equities to the public. It's kind of a big deal. It's also much more uncertainty about the value of the securities. So oftentimes what investment bankers will do is they'll come out of the gate with a relatively low price with the expectation that it will go up by a good bit in the next few days of trading. And that'll keep people coming back to me to buy more securities from me, which will help the next company that goes public. SEOs are a little bit safer, of course, because we already know what the shares are trading for. We just want to issue more shares so that we can do a new project. Another couple of terms here, a pair of terms that you should know about: general cash offering or a rights offering. These both relate to seasoned equity offerings, shares that are already trading in the public and we're just wanting to increase the number thereof. There are two ways that I can do that. A general cash offering is just to the entire marketplace. So I go out there, I've got 10 million shares outstanding. I want to issue an additional 2 million shares. So we offer it at the market price minus a little bit, just to induce you to go out and buy these extra shares. All right, great. That's one way to do it. Another way to do it that's a little cheaper is a rights offering. So instead of just taking those 2 million shares and just putting them out to the world, what I could do is I take those 2 million shares, and for each, let's see, if you have 100 shares already, one round lot is 100 shares, I'm going to give you a piece of paper that says you have the right to buy an additional 20 shares at this slightly below market price. Again, to induce you to take this deal. That's a rights offering. So it's direct to the existing shareholders. Nobody else gets to participate in this unless you own shares in the company. Turns out rights offerings are cheaper, at least when compared to general cash offerings. But guess how many general cash offerings we have in the U.S. relative to rights offerings? It's about 9 to 1. 90% of them are typically general cash offerings. About 10% are rights offerings. Another quirk, though, go across the pond. Look at the UK. Look at England. What's their ratio? Flip it. Most of their offerings are rights offerings, and very few are general cash offerings. We've studied this stuff. We still don't have an answer. I've written some papers on it. Others have written papers on this, and it's a tough thing to figure out. These markets are complicated, but That's the way it is. We don't know the counterfactual. And anyway, that's the difference between a rights offering and a general cash offering. Now we have another pair of terms, firm commitment versus best efforts. I told you there were a lot of terms in this chapter. Okay, firm commitment versus best efforts has to do, once we've determined who we're going to have us, who is going to help us to do this issue, which investment bank. Now we have to figure out, is the investment bank actually going to buy all the shares off of us, give us cash, and let us go about our business and make this new investment? Or are they just going to help us sell these shares to the public? If it's the former, in other words, they're going to buy them off of us, give us cash, and we walk away, that's a firm commitment. So in other words, the investment banker is actually taking risk on these. They're buying us out. They're becoming kind of a middleman, and then they'll turn around and sell it to the public at a higher price. They'll buy at a discounted price from the firm, and then they'll sell it to the public at a slightly elevated price, usually 7 to 10% higher. In fact, there's a very famous paper that started when we first started studying this stuff back in the, I want to say it's the 80s or something, called the 7% solution. And it relates directly to that idea, is that, the basic cost that the investment banker charges for a firm commitment is 7%, plus a bunch of other fees, legal, accounting, yada, yada, yada. Best efforts basically says, you know what? Yeah, we'd be happy to help you with this offering. We'll put it together. We'll give it our best. We'll put together a network, a consortium of other investment bankers, what they call actually a syndicate. We'll put together a big syndicate to distribute these shares. But you know what? They're yours until we sell them. I'm not going to put my money into it, is basically what they're saying. Right? That's a best efforts. So basically, a best efforts is kind of a glorified marketing network. And again, some firms decide to go with the best efforts because it's cheaper. Firm commitment is expensive. There's no question about it. But the downside to a best efforts, you might not sell everything. And if you need a specific amount of money to do that investment and you don't sell it all, too bad. You're going to have to come up with that cash somewhere else or scale back on your investment somehow. So the nice thing about the firm commitment, you get the cash. You get what you need to do your project. You can walk away and let somebody else deal with selling it and worry about that. That's not my worry. Yeah? So a lot of reason. And I want to say that more of the issues are firm commitments than best efforts. I can't tell you off the top of my head, though, the percentages on that. I don't think it's quite as lopsided as, say, the general cash offering versus rights offerings, or the negotiated versus competitive lopsidedness. But more of them tend to be firm commitments. Here's an example of how to do an IPO getting started here. I'm going to, just in the interest of time, it's a little after, right, or is it right at 9? It's right at 9. So I'm going to skip over this. This is something that you can just read through. Probably doesn't require a lot of explanation. It just walks you through the process chronologically as to what's happening. Underwriters, here's what they call an IPO tombstone. And one thing I will point out on this is that usually the reason it was called a tombstone is that it would fill an entire page of the Wall Street Journal. This one is kind of split up just to fit it in here so that we can see it. And it's not tiny mice type. But this particular one, it tells us how many shares are offered in the entire offer. It tells us the expected price. There's actually there's an international offering. Only 9.2 million shares are being offered in the U.S. The additional, 2.3 million shares are being offered outside the U.S. This is Class A, common stock. We've got all that information. Then we go over here to the bottom part of the tombstone, and we see a bunch of investment firms, investment banks: Bear Stearns, Credit Suisse, Merrill Lynch, Witt Capital. And then notice the font size here. Then we've got another list down here: Allen and Company, Bank of America, Deutsche Bank, Donaldson, Lufkin, Jenrette, A.G. Edwards, et cetera, et cetera, et cetera. Now, these happen to be listed alphabetically. That's information to us. We also notice that these guys are listed alphabetically. But notice the font size. This is very important to the investment bankers. These guys up here, these top four, they're the syndicate leaders. They're basically the lead underwriters. And it looks like they kind of equally share that role. That also means they're getting the biggest chunk of the cash. Now, if Goldman Sachs happened to be part of this deal, Goldman would require that they are right here in even bigger font than anybody else. They're either first or they're not on the page. That's kind of the game that some of these investment bankers play. The leading investment bankers, they're a little more calm about that stuff. But for instance, Goldman, you will never see Goldman on a second line. They just won't be there. If they don't get to be the lead underwriter, even the lead among the leads, they're not going to take the deal. My game, or you go somewhere else. These guys down here, these guys more than likely are part of the distribution syndicate. So they really didn't have much to do with actually constructing the offer, putting it together, pricing it, doing the roadshow. None of that. What they're there for is to, Allen and Company is going to get some percentage of the shares that they are required to buy and to distribute to their client base. Bank of America Securities is going to get another percentage, and they have to take it and distribute it to their network of clients and customers. Likewise with Deutsche Bank, Donaldson, Lufkin, Jenrette, A.G. Edwards, etc., all the way down the line. Jefferies is down here. Sanders Morris, Wachovia. Everybody gets some percentage, and they get paid to market and use. Basically, we're using their distribution network to spread these shares across the country. And then on the international piece of it, we only see 3 lead underwriters, and they're probably using their own distribution network for those, because I don't see anybody else below them. So they're kind of hanging on to that piece themselves. Maybe they think it's a little more lucrative. I don't know. All right. So you can read a lot from just a tombstone ad. You can learn a lot about who's doing what. All right, 905. This is kind of an interesting one. I don't want to necessarily leave you with Patrick Barnes' kind of diatribe that he goes off on here. So hopefully we'll have a few minutes. I can kind of disavow some of the things that he and the hosts of this show go on about, and maybe confirm others. But this is kind of an interesting thing. So let's see if I can get the sound to work on this. And all right. And here we go.
How to kill all mosquitoes.
Everybody got sound there? All right, great. And we'll go
In the area in 90 seconds? This simple but brilliant trick you can do tonight to eliminate all mosquitoes around you is taking America by storm. An ingenious college
Our next guest in today's Google Fest is the CEO. This guy is such a hoot. Is the CEO of Overstock.com. They went public the Google way. This is Patrick Byrne, the larger-than-life Overstock.com CEO. Patrick, given the fact that Pete, P-E-T, which also worked, and Overstock came public this Dutch Street way, I mean, can't we just say, what the heck? It's certainly better than the way that they did it before.
Absolutely. This is hands down a better system. It's a better mousetrap. It's not ambiguous. It doesn't trade anything off. People are going to look back in 3 years and say, how did the conventional Wall Street system last as long as it did?
Why is it so much better?
Well, because the conventional Wall Street system is corrupt.
Right. Thank you.
Yeah, well, it is corrupt.
Well,
you know, Jim.
I
worked on Wall Street.
I thought I was the only one who ever said any stuff like this. Yeah, I hope my dad's watching. I was throwing the rocks. Like, go ahead, man.
Why is this better?
I can explain it in 3 points. First, as a general principle, anywhere in human affairs that there's guaranteed profit to be allocated, there's kickbacks. Doesn't matter if you're talking about some third world customs official or a white shoe Wall Street banker. It happens. Secondly, the conventional system guarantees profit. They get the heat going about the stock, then they underprice it, shovel it to their buddy in some sleazy hedge fund.
You compared it to, you gave a Lexus example once.
Yeah, well, it's too long. You guys always cut me off when I start talking.
No, you got the ball.
Okay, if I had a Lexus, no, you have a Lexus, Jim, and it's a $30,000 Lexus. You hire me to...
No, it's actually 60, but that's
okay, $60,000 Lexus, you hire me to go sell it for you. I take it out, and I sell it to a buddy of... You hire me to go sell it. I sell it to a friend of mine for $30,000 instead of 60, then he turns around and sells it for 60. You know, have I defended your interests? No. And now
But that's what Wall Street does all the time.
So what they do all the time, and now what if it turned out that my buddy actually had me come over the next day and I mowed his yard or something, gave me 10 grand to mow his yard? It's clearly a payoff. That's how the whole system works. So the Handbrake system, because it's an auction, doesn't allow that sort of guaranteed profit to be allocated. And that's why the conventional old boy system hates it. And people are going to look back and say, gee, why did we ever put up with that for so long?
I think you're totally right. We've been doing it with this one way for 100 years. Let me ask you something, Patrick. You're Elliot Spitzer, okay? There's a cartel that sets the price between 6 and 7%. This deal, doesn't it show you that the cartel is a useless, monopolizing entity that extracts wealth out of people who typically only go through it once and therefore don't know any better?
Absolutely, and I think that's probably an insult to cartels. I mean, these people are worse. I had people threaten me that if I went with Handbrake, I had all the banks tell me, I'll work with any other bank, but if you go with Handbrake, we'll never pick up analyst coverage on you. That was one of the ways. I don't negotiate with terrorists. As soon as they told me that, I said, I'm going with Handbrake. But Elliot's, you know, it's a useless cartel that extracts rents by shoveling underpriced IPO allocations to their buddy in some sleazy hedge fund, and then the hedge funds give them the kickbacks. That's why in the last couple of years you've seen these banks paying $100 million and $1 billion fine in one case, and there's one guy who's on trial right now in New York for doing this stuff.
Mr. Byrne, let me ask you this. A lot of folks have said, oh, if we had Dutch auctions, this would avoid the bubble. I understand how a Dutch auction will make sure that the company gets a lot more money that they left on the table, but doesn't this also make a lot of individual investors possible to be suckers and getting in really early and paying way too much at the beginning, just like they did back in 1998 and 1999? They're not going to be anything preventing them from getting in.
Well, I understand your point, but what the individual investor who thinks they're going to get in on some IPO that's going to triple in the first week, they should stay home because it's not going to happen. If there's that kind of demand, to begin with, the auction is going to find it, so you're not going to get a big triple. Now, I've worked with Handbrake. I did it once. They will price in a 5 to 10% tailwind, so everybody understands it comes out of the gate and it trades up a bit. But the guys who are in there to get a flip should stay home because they're not going to get it. Therefore, the only people who bid should be the people who understand the business, like it. They're not getting in because they think they're getting some piece of paper on an uptick. They're not day traders. They're people who understand the business and think that it's a reasonable price.
Thank you, Patrick.
Thank you for having me again.
Man, don't ever change. stay the way you are. They haven't gotten to you yet.
Oh, never.
All right. A little flamboyant, shall we say? Am I back? Can you hear me? Oh, yeah. Thanks. Yeah. So where do I start unpacking this? I wanted you to hear this because this was on CNBC, and Kudlow and Kramer still around. I don't know if you watched them, but this is some of the kind of a little bit out there sort of stuff. Now, certainly Patrick Burns, he's gotten into some few problems with the law, shall we say. I've got a link here. You can take a look if you want to dig into where Patrick is these days. But I forget if he's actually serving some time. But if he isn't, he may be or has already. So this Dutch auction versus the typical way of going public, most of what both Burns and Kramer were alluding to, Kudlow didn't really tip her hand on this, but those two were really out there as like, oh no, they're scammers. The Wall Street is a complete racket. Yeah, there's certainly some truth to that. There's no question about it. Not unlike you look at real estate brokers, right? It's 6%. Why is it the same? Well, maybe that's because that's what it actually costs. Now, a Dutch auction, and I'll try to keep this short, and then we'll pick up on Thursday here and finish this up and finish up chapter 5, touch on the few points on 19 and 20. But a Dutch auction basically works like this. And the reason it worked for Google was that when you used to go back before Google was publicly traded, you'd go to google.com. There would be the search bar that you were typing in your search string. And then right below that, there was another link. You could actually put a bid in to get some shares of Google when it did its IPO. You would say, these are how many shares I want. This is the price that I'm willing to pay. Here's the way it works. If I want to sell 1 million shares, now let's make it easier. Let's say it's 100 shares. So I want to sell 100 shares. I get a bid for 50 shares at $100. I get a bid for 40 shares at $90. And I get a bid for 20 shares at $85. And I get a bid of $75 for, say, 300 shares. And I get some other bids down here too at lower prices. Now, I only want to sell 100 shares. I've already made that determination. So here's 50. Here's 40. That gets me to 90. Here's another 20. Oh, that gets me over. So I'm only going to take 10 of these. So now I'm at my 100. And that's where I'm going to stop. This is the price where I stopped. This price is the price that all of these folks, including these 90 shares up here, they're all going to pay 85, even though they bid a higher price. I'm going to give them a deal and they're going to pay 85. That's what I give them for revealing their valuation truthfully to me. Otherwise, why would they reveal it, right? If I know it's really worth 100 and they charge me 100, well, I'm not getting much of a deal. And so why should I tell you? I'll just say, well, I actually think it's only worth 70, and hope that I get an allocation. Well, and that works great for companies that were already household names. Doesn't work so great for companies that you've never heard of. You've got no idea what the thing is worth. Even Google, it was tough, but there were millions and millions of people bidding on Google. So it actually worked pretty well for Google. And it might have even worked for Overstock, because Overstock was fairly well known too at that time. But it's not a panacea. It's not as clear-cut as what Kramer and Burns were trying to make it out to be. Clearly not. And I don't want to keep you any longer. We're already a minute over. And so we'll pick up here. I'll give you a little more detail on Dutch auctions versus the traditional method. And then we'll continue on to chapter 5